Hi, Natalie.
Hey, how are you?
Good, good. That's Natalie, right? Yeah. How's baby?
She's great. You saying hi?
Yeah. Can I see the baby real quick?
Yeah, you want to see? Come here.
What the heck?
Come on. Look. Say hi.
Hi.
Hey, hey, you remember me? You remember my little stunt? You ready? Da 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 da. I don't know why babies like that so much. How you doing, huh? You're a cute one. What's the name again?
Millie.
Millie, how you doing? Yeah, your mommy's going to school now, huh?
Mm-hmm.
And hopefully it's not just the three of us today, huh? So we'll wait a few minutes. We're a little bit early, about 5 of. No problem doing the assignments, I can see, right?
No.
Yeah, not too bad so far. Those chapter summaries sound unappealing, but those are nice, easy points to scoop up toward your, grade point. So,
Yeah, it only took me about a half an hour to, reread through the chapter and then, summarize that. And it was actually pretty easy to, I mean, I actually had a hard time trying to fit it all in 3 pages.
Well, that's good. That's good. You're not limited to 3 pages by any means.
Got it. Okay.
That's my boss's recommendation, so that's what I'm gonna be going with, huh?
Okay.
Have you looked at chapter 2 at all yet?
I have not, but I
Okay.
see the chapter 2 summary is due Wednesday, correct?
I have to look. Yeah.
Okay.
The summaries, I guess, are due. I mean, I just don't remember off the top of my head how I set that up.
Okay.
And we'll go from there. But let's see. Let's hopefully get some company here, huh? My goodness. And where is everybody?
How many people are in this class?
We started off with like a small class, like 17. We've added about 10 people. They're coming out of the woodwork. I've gotten about 6 requests for authorization codes, and then a few people transferred in from one of the other 110 classes. Maybe they think this is the easy one. I don't know. But we shall see. You're the one from Minnesota, right?
Yes.
All right. I was telling somebody that we have a student from Minnesota, and I made a bad joke that she's from the cold part of town, the cold part of the state.
Mm-hmm. It's cold over there.
Yeah, quite different, huh? What brought you out here?
I've got some family out here.
Ah,
wanted something different.
excellent. We're glad to have you. All right. You can tell I'm getting antsy waiting to see what kind of a crowd we draw here. If nobody else shows up, that could be good or bad. We either have a very smart class or a very dumb, lazy group, but I think we got a pretty smart group here. And we'll go from there. So what do you do for excitement? You hang out with Millie, I guess, right? That's your whole excitement, right?
Yeah, I'm also working full time, so.
Ah.
So
and where do you work, did you say?
I work over at the Nugget in Goleta.
The Nugget, the restaurant?
Yeah, I'm the bar manager over there.
Oh, really? That's near the Kentucky Fried Chicken guy there?
Yeah, right next to it.
Yeah, not been in that place all these years. Boy, that's undergone different ownerships over the years and different types of places there, huh?
Mm-hmm. I think so. The Nugget's been there for, I think, 10 or 11 years now, but.
Okay. You recommend it, huh?
Yeah, it's not bad. If you like good classic American food.
Barbecue, right?
Yeah.
Okay, we have Roby is here. All right, now we're rolling, huh? Hi, Roby. Oops, what happened? I lost everybody. Oop, unmute. Oh, can you hear me, Roby?
Can you hear me?
Now I can hear you. I had you muted by mistake. And it's just you and Natalie so far. We gotta see if we get a few more people here. If not, we'll be able to roll through this chapter, huh?
Okay.
Looks like you had no problem doing the assignments, huh, for the first chapter?
I figured it out.
Pretty basic stuff to get started, huh?
Well, yeah.
Yeah, we'll go. Chapter 2. We'll start in a couple minutes here. Chapter 2. We'll finally see a few numbers, transactions, and then we really pick up the pace when we get to chapter 3, when we start talking debits and credits. We're not up to that point yet.
No.
Hi, Kelly. How you doing?
I'm good. How are you doing?
Good. I can hear you now. I guess we've got enough to get started, huh? Looks like you all did the assignments. You did all the assignments, right, Kelly?
Yes, I did.
Okay. All right. Yeah, those chapter summaries, I keep telling people, those are helpful. Plus, they are easy points to pick up toward your grade. So you don't want to miss doing those things, okay? All right. Let's see what we got here. Hold on here. Give me a moment here to share the screen. Share screen. Share screen. Okay. Make it big for me. You can all see the PowerPoint?
Yeah, I see it.
Okay. What we'll do is we'll go through this, learn a few terms. We'll go through some transactions, and we're going to be using the words plus and minus, huh, when we increase something. And then in chapter 3, we finally start speaking the language of accounting, the debits and credits. So here we go, okay? The accounting elements, a business entity. The business entity. Let me just move this out of the way. Anybody who's has an entity trying to make some money, some profit, that's a business entity. It could be an individual, a group, a corporation, and the company's finances are kept separate. Let me do one thing. I was distracting myself watching television. In this chapter here, we're working with small businesses where the owner might have some personal money in the business in the form of taking cash out. And the point is the business has its money and it's not supposed to be mixed up with the personal. The owner of the business may have assets and non-business items. The non-business is not part of the business. I'm skipping this one. Here we go. We're going to learn the accounting equation to start. Assets equal liabilities plus equity. That's the accounting equation. Assets. Assets. What's an asset? Anything of value owned by the company. It doesn't mean that it's paid off yet, but it's yours. You could have a fleet of cars that you have purchased and you're paying those cars off over a period of time. That's an asset. Assets, good things to have. Cash, merchandise, that's inventory. You walk into Nordstrom's, the clothing you see there, that's their merchandise that they sell. Merchandise, furniture, fixtures, maybe something that like an air conditioning unit that's stuck in the building and you're never going to go anywhere, machinery, etc. And then accounts receivable. That's one we're going to work a lot with in this class, accounts receivable. That's an asset. It represents the dollars in total owed to you by your customers. Accounts receivable, the amount of money owed to the business by its customers by making a sale, okay? You sell something on credit, which is how the whole world works. You hope to be paid later. That is an asset called accounts receivable. And when they finally pay you, you lose that asset, but you get a better one, which is called cash. So assets, something good to own. Liabilities, these are debts, huh? This is a debt. This is an IOU. This is an obligation to pay something. And they give you a fancy term of probable future outflow of asset. That's nonsense. It's a debt, is what we're talking about, an IOU. Accounts payable and notes payable are two different things, and we'll get comfortable with that eventually. Accounts payable is the opposite of accounts receivable. Accounts receivable represents monies owed to you by customers. Accounts payable represents monies you owe to your suppliers. You owe that to the landlord. You owe that to the person who sells you your merchandise that you hope to resell. Accounts payable, the normal trade payables, let's call it, your normal course of business. Notes payable is a borrowing situation. A note is different from accounts payable. A note has interest attached to it. It has a formal contract. Accounts payable, there's no written contract. It's just an agreement between you and your vendor. And here we go. Accounts payable, an unwritten promise to pay. Purchase on account. And this is a good tip they put on the slide. Don't confuse accounts receivable or accounts payable. Very easy mistake to make. So you have to ask yourself, are we waiting to receive money or are we waiting to pay? And if we're receiving, that's accounts receivable. Notes payable, that, like I said, that's a formal written process, specific sums of money to be paid at a particular time. There's an interest element. There are penalties if you don't pay. Owner's equity. This is the third part of our equation. Assets equal liabilities plus owner's equity. I guess another way to say it is assets minus liabilities equals owner's equity. This is the net worth of the business. This is what the business is worth on paper. It may very, very likely have nothing to do with what the business is really worth to the public. This is the net worth of the business. Your assets exceed your liabilities. You have equity. Assets and the cost of, I don't like that slide. I'm going to add this thing. The accounting equation. Assets equals liabilities plus equity. Assets, and give me a moment here to move this thing out of my way. Oh, hi, Vincent. Good to see you. Just take a look at this simple equation here. They don't really lay it out the way I like in the book, but here you go. Here's your accounting equation. This is the accounting equation. Assets, this company has $300,000 worth of assets. That's the valuable things they own. Does that mean you would pay $300,000 to buy this company? Maybe not, because they have debts, liabilities. They have debts of 100,000. So I guess this would be 200,000 here. This business on paper is worth $200,000. And that might be a starting point in negotiating to buy the business or invest in it. Assets equals liabilities plus equity. And this equation must always be in balance. It is impossible for it to be allowed to get out of balance. It always must be in balance, okay? We're back to the PowerPoint. You all see the PowerPoint? You see that? Just somebody say yes, we see it.
Yes.
Yes, I see it.
Okay.
All I see is the
Yes.
title page.
Hold on, I lost my cursor here. What happened to my cursor? Come on, you stupid thing. Oh, there we go. It sounds silly that I asked, but I want to get in the habit of doing that because I've made a mistake in the past where I didn't share And I'm babbling to the students thinking that they're looking at it and it ain't there. So, I'd rather look a little dumb this way, okay? Okay. We're back in our famous PowerPoints, and I have to move this thing around. You can't see what I'm doing, but business entity, we talked about assets equals liabilities plus equity. The accounting equation, assets equals liabilities plus equity. I guess you can tell that's important, huh?
Yep.
The accounting equation. So if a business has assets of 60,400, liabilities, what is the equity? It would be 55,000 because assets equal liabilities plus equity. Okay. Analyze some business transactions. What's a transaction? It's any event that occurs that affects the business in terms of dollars, huh? And it often, and that's correct, it usually requires an exchange with an outside party. You buy something from somebody, you sell something to somebody, you pay the electric bill, you buy insurance, you get the idea, an outside party, and you always have to measure it in dollars, okay, in some kind of currency. And each transaction affects the accounting equation in specific areas. And every transaction has to have two parts. What is an account? Okay. They're saying here, all business transactions affect the equation through specific accounts. The accounts are the assets we were talking about before. Cash is an account, accounts receivable, accounts payable. When we get into this income statement, sales is an account, so is tax expense, payroll expense. An account is any particular folder that you want to collect information within. So you get a transaction, you say to yourself, what happened? What of those folders, what of those accounts are affected? Which ones? And then you have to say to yourself, which one goes up and which one goes down, okay? Make sure you understand what's taking place. It could be something as simple as the electric bill came in the mail today. Well, guess what? That's a bill we're going to have to pay now or later. Well, we're probably going to pay it later. So we are going to increase the electricity expense, if that's what we want to call it, or utilities expense, but we're also going to increase the liability called accounts payable, okay? It could be something as simple as that. A transaction can be, it's payday. We got to pay our people. We bought something from somebody. We signed a contract that requires a down payment. These are the different types of transactions. And now I think they're going to take us through some transactions, and we'll go through this. Mitchell's campus delivery. Whoa. Let's analyze the transactions for this guy. Mitchell Williams is a college student. He invested $5,000 in the business. That's pretty good money for a college student, huh? So he took $5,000 out of his bank and he deposited it in a new company. He registered the business, I guess, in whatever state and city he's in. So what has happened? He now has a business that consists of one asset, cash. So cash went from 0 up to 5,000. And the business is now worth 5,000 since there are no liabilities. The capital went up. The capital went up. So he invested his own money. We know an asset went up. We know the owner's equity went up. And what asset? Cash. Capital increased. So here's his accounting equation. So there we go. There's a quick 2-second look at the accounting equation after this first transaction. Not too tough at this point, huh? Now he bought some delivery equipment. Okay, what happened? He bought equipment. He paid cash for it. So cash is an asset that goes down because he paid cash, but he got another asset in the form of delivery equipment. It's just an exchange of assets, okay? So let's take a look at our accounting equation. Now the accounting equation has cash is down to 3. Delivery equipment went up 2, so the total assets are still 5,000 and we're still in balance. We're still in balance. He bought more delivery equipment, but this time it's on account. And I say this as a little bit of a joke, but it makes sense to me. When you see the words on account, and you will quite a bit, it means on account and nobody had money. That's exactly what it means. He bought delivery equipment on account. He is going to pay for that later. So he now has his first debt, his first liability, called accounts payable. So delivery equipment went up, and so did the liability, the debt, the IOU. And here we go. Let's look again. His assets have now grown by that 1,800. He now has a total assets of 6,800, but his capital is still only 5 because he incurred this debt. He is going to pay that later. And when we say accounts payable, we're talking typically 30 days. That's sort of the norm throughout most of American business, I think, from what I know and see. The deal is you ship your product to me and I'll pay you in 30 days and we'll be good business partners. Now he's paying part of that payable. He's paying part of it. He owes 1,800, he's paying 6. So the cash is going to go down. And what's going to happen to the accounts payable? Is it going to go up or down? Anybody want to guess? Nobody wants to guess. The accounts payable goes down because you don't owe that 600 anymore. So what's happened here? His assets have now decreased by virtue of paying part of this bill. His assets have dropped to 6,200, but his debt has also dropped, and we're still in balance. The business is still worth $5,000 on paper. Now we're introducing revenues. Sales is what we're talking about. Fees. Monies you earn from selling your product or your service. It can be in the form of cash or a receivable. The key here is you recognize the revenue when you earn it. In other words, you sold something to me for $1,000, and the deal is I pay you in 30 days. You record the revenue the moment you ship the product to me. That's when you record the revenue. It doesn't follow the cash necessarily, okay? So revenues, this guy's a delivery service, so I guess he's going to call his revenues delivery fees. So let's see. Revenues and expenses. Well, I think we all know what expenses are, huh? Any of us have ever had to pay rent or buy insurance or stationery, pay taxes, expenses, huh? Revenues are monies coming in, expenses going out, huh? Revenues minus expenses, guess what, is your net profit. But I bet you didn't have to go to school to learn that, huh? If your sales are more than your expenses, you made money, okay? This is just a little thing that I do want to look at quickly, the accounting period concept. There are various principles of accounting, and one of them has the silly word you'll never hear anywhere else, periodicity. It just means that any business can be split up into specific finite time periods for purposes of analysis. Typically, businesses prepare financial statements monthly. This book, you're always talking about 12 months. 12 months is a fiscal year, not necessarily a calendar year, huh? But a month, company can say, I want to run financial statements for the month of January, and then maybe at the end of March, they'd want to do them for the quarter, etc. Period. You can divide up. And here's what I was saying before. Revenues were 9,000, expenses were 5. Hey, we have net income. How about that? But here, revenues were 3, the expenses were 5. We lost money. And guess what? That's going to reduce our equity, just like income will increase the equity. Here, withdrawals, here is where we're talking about a small business where the owner's money goes in and out, and when they take it back out for their own use, it's a personal thing called a withdrawal, okay? You're working for a company, you're the accounting person, and your boss comes up to you and says, hey, Roby, can you give me a check for $1,000? And of course you're going to give it to him or her, but you're a good guy, and you just say, oh yeah, no problem, boss, what's this for? And the boss says, I'm taking my family to Las Vegas for vacation. At that point, you know it's a personal item. It has nothing to do with the business. So we're going to reduce the cash, and we're going to increase an account called drawing, which actually reduces the owner's equity. The owner's equity. We see something here. Yeah. Can you read this here? Cash, delivery equipment? That's legible. Okay. So what's happened here is you had 5,000 in capital to begin with, and now this person is going to be taking money out. So let's see what happened here. Wow, withdrew 2,100, taking most of the cash out. The cash is coming. Oh, I'm sorry. He received 2,100. This I don't like. They're talking about the withdrawals, but they're not really showing it to you, which is foolish. Anyway, here's a sale for cash. A sale. He delivered pizzas to the dormitories on this campus, huh? And he collected 2,100 in cash. So cash is going to go up, and that's considered a sale. A sale. As soon as he handed that dorm room a pizza, that was a sale to be recognized. So cash goes up and revenues go up as well. And let's take a look at it. Here is the 2,100 he received that day for delivering pizzas, or that month, whatever. And revenues go up. Revenues or sales went up. Obviously, we want sales to go up, up, up. Revenues maintained reasonably below that, okay? That's a sale for cash. Here's an expense. He rented an office. He rented an office for $1,000, and he paid cash. Whenever you see the word paid, that means cash. Sometimes the students get confused. They say, well, it says he paid. Did he pay now or pay later? When they say paid, they mean he paid up front, okay? So here's an expense. Cash is going to go down, and an expense is going to go up. And that folder or account we'll call rent expense. So let's see what we have here. He paid $1,000 for an expense called rent. So far he's got 2,100 in sales and 1,000 here. So far he's making a profit of 1,100. Whatever profit sits here at the end of the month, we're going to learn shortly how it gets moved over to capital. Okay? He paid the phone bill. That's another expense, $100. Cash went down. Here's another expense. We're going to call it the phone bill, the phone expense, cash. Now here, we're getting into the area of a sale, but not for cash. It's on account. On account of there was no money involved. On account of nobody had money. The revenue increases, but the deal is these people are going to pay us later. So the revenue goes up, so does accounts receivable. We now have customers who owe us this money. Take a look at the accounting equation. Receivables went up, accounts receivable, and that was the result of a sale or a revenue, okay? By the way, I can't wait till we get to chapter 3 when we start talking debits and credits. But if you can do this homework on these rather simple transactions and understand that accounting equation and get familiar with the terms, it's a big, big head start. He bought supplies, huh? He bought supplies for $80. Big deal. These supplies, though, are going to last for several months. Guess what? Those supplies he bought are not considered an expense at this point. It's considered an asset. It's considered a prepaid asset. A prepaid asset we're going to call prepaid supplies. He bought $80 worth of supplies, say, on the 31st of January, but he hasn't used them yet. You can't record the expense until you actually use the supplies. Until then, it's an asset. He's got $80 worth of cleaning supplies or something. Here's our equation. Cash went down, supplies. Whenever you see the word supplies by itself, it should say prepaid supplies. I've been complaining about this for a long time. It should be called prepaid supplies. We're going to learn a lot about prepaid accounts in this class. Prepaid assets, also called prepaid expenses, the same thing. Hey, remember that sale we made for $2,400 on account? Somebody just sent us a check for $1,900. So what's happened here? Our cash is obviously not going to, is obviously going up, but the other asset, accounts receivable, is going down, and that's good. We would rather have the cash than the receivable, huh? Here is our equation. Cash went up, receivable went down, everything stayed the same over here, no activity. Okay? The accounting equation is in balance. Here he bought something on account, plus he made a partial payment. So this is our first entry with 3 accounts to worry about. So what's happened here? He bought a scooter. Well, that's an asset, so I guess we're going to increase scooter. He paid cash. So, gee, cash goes down. That other $700, we're going to pay it later. That's accounts payable. The person who sold us the scooter, it's his accounts receivable. One man's accounts receivable is another man or woman's accounts payable, huh? So let's see here. Cash went up by 300, so the equipment went up by 1,000. Oh, this thing's playing tricks on me. Hold on one second here. Come on. Have to do it that way. So here we go. He paid $300 in cash, reducing the cash balance. He got his $1,000 delivery bike or whatever the heck it was, and his accounts payable went up as well. He's going to have to pay the balance of that transaction. Now, here's a better example of a prepaid asset. And notice they are using the right word, prepaid. This is a little beyond you right now. You're probably seeing this for the first time. A prepaid asset is something you buy to be consumed later. And the best example, and the one I always use, is this, an insurance premium. He paid $700 for a policy that lasts 7 months. Okay, 7 months. So that's an asset worth $700 when you bought it on the 31st of, say, December. So every month you're going to increase your expense by $1,000 and reduce that asset. But let's first do the simple part. He bought an asset called prepaid insurance. Cash went down, this asset went up. He bought this on December 31st, I'm saying. If his business burned down on New Year's Eve, he doesn't have any insurance. because the policy doesn't kick in until the 1st of the new year, okay? If his business burned down on January 1st, two things would happen. He'd have insurance, and he'd also have an insurance investigator there in 2 minutes, very suspicious, okay? You use the insurance later. Payment of wages. Okay, well, here we go. We pay our people. He has people working for him. And that's an expense. Wages expense goes up and cash goes down. Look at this. We have another expense. Whoa. Cash goes down. Wages expense goes up. So just looking at it quickly, we have 4,500 in sales, 3,750. So he's making a little bit of money now. He's having a good month. Here we go. Just like earlier, we bought something for cash down payment plus a liability later. Here, we're extending credit to a customer. We delivered a whole bunch of pizzas for $3,500. We only got $900 in cash because the arrangement is the other $2,600 is going to be paid later. Okay? This person delivered pizzas to UCSB, and the ones he delivered to students, that's the $900. They had to pay cash. The $2,600, that was for a big faculty party, and he trusts that the school will pay later. So we have 3 items to worry about. Cash goes up. So does that other lovely asset called accounts receivable. And the sale amount is $3,500. You notice that the sale is $3,500. It has nothing to do at all with when we pay the bill. That's called accrual accounting. And I'm going to throw that word out now, although it's going to come up a little later. We work on the basis of accrual accounting, which simply means revenues are recorded when you experience them, when they're incurred, and the same thing with expenses. If you ever hear anybody say, well, I work for a business and I run my business on cash basis accounting. If you run your business on cash basis accounting, you're going to cash basis yourself out of business. And you'll learn why as we go along, because you're not going to be able to come up with readable or useful financial statements. If your business is run on a cash basis, it's not GAAP. No one will attest to them. You can't borrow money. You can't get people to invest in your business. Nobody's going to sell it to you. You get the idea. Accrual, A-C-C-R-U-A-L. Now here's the withdrawal. The boss came out and said, hey, Natalie, give me a check for $3,000. I'm taking my family to Disney World, okay? As soon as you hear that, you know it's a withdrawal. It has nothing to do with the business, okay? So you know the cash is going to go down and the equity goes down. Withdrawal immediately reduces your equity, immediately, unlike revenues and expenses, which are rolled up at month end, okay? So the boss needed $3,000 to go to Disney World. He reduced then the equity. The equity went down by $3,000, okay? The equity went down by $3,000. Okay, those were, I don't want to call them simple transactions, but those are the things you gotta, work on this week. It's like batting, me, the sports guy. It's like batting practice. You just keep attacking at it, like shooting layups. You get the fundamentals down. Withdrawals. Now we're up to a more, I hope, a little more interesting part. Now that we've prepared all these transactions, the month has now come to an end. We are prepared. We are ready, I should say, to prepare the 3 financial statements: the income statement, the statement of owner's equity, and the balance sheet. These are the 3 statements that every business prepares, and they must be prepared in this exact order: income statement, statement of equity, and balance sheet. And you'll learn why if you get stuck on your homework. You can only do it in that sequence, okay? So let's see what we have here. Income statement Equity statement, balance sheet, huh? And at the top of the statement, you put the name of the company and if it's the income statement. And it should say, if it's the income statement or equity, you say for month ended. If it's the balance sheet, you don't say for month ended. You say as of or at, because the balance sheet is a snapshot of your assets at a point in time. And we'll get into that. I looked at this earlier. Let's see what they're talking about. Financial statements are prepared primarily for users not associated with the company. Well, that's reasonably true. Why do you prepare financial statements? Well, one reason you might want to go to a bank and borrow money, and they want to see if you're making money. You might want to offer stock. You might decide to incorporate, and no one's going to buy stock in a business unless you can prove you're making money. These rules about underlines, don't worry about that. On the income statement. All of this is all baloney, I think, from 1 to 5. So I'm going to ignore it. I'm not saying it's wrong. It's just that I'm not interested in it for purposes of our class. Here's something you need to understand, huh? Assets on the balance sheet, assets are listed from most liquid to least liquid. Liquidity. Liquidity is a term that means the ability to turn something into cash. Cash is liquid itself. Liquidity. Accounts receivable will always come after cash. Accounts receivable, you can turn that into cash very easily because you have reasonable expectation you're going to get paid in 30 days. Or you could have $1 million worth of accounts receivable, but you really need money. You could go to the bank and tell the bank, hey, look what I have here, banker. I've got $1 million in accounts receivable. I've got good customers. They're going to pay me. How much will you give me for it now? The bank might say, I won't give you $1 million. I'll give you 800,000. And you might take it. The point is, accounts receivable, very liquid. Your inventory is a little less liquid, etc. Until you get to things like equipment. You can't turn that into cash very easily. So here we go. Here you go, our first income statement. Our first income statement. And what's really frustrating me here is, okay, I hope you can all see this. Mitchell's campus income statement for the month ended. Their revenues were $8,000. If we go back up to our accounting equation, we would see they had sales of $8,000. And remember, they incurred 3 expenses: wages, rent, and phone. You add them up, you got $2,750. And if I'm reading that correctly, my eyes are not that good, that's $5,250 net income or net profit. Either word is acceptable, net income or net profit. This is bottom line, if you want to call it that, before taxes. He made income of $5,250. If you make income, your equity is going to go up. We should know that intuitively, right? Let me show you how we do it now. We do the income statement first because we must find how much money we made. We made $5,250. That's going to increase your equity. So let's take a look at the equity statement. The equity statement records the activities that affect the equity for that period. And students tend to get a little shook up at this at first. It's really not that tough. They make it harder than it really looks. All it is the equity balance at the beginning of the period, which in this case was 0, right? He didn't have any equity when he started, before he started the business. He then invested $5,000, which brought the equity up to 5. He had income of $5,250 minus that. There's his net income. This business is now at the end of the month worth $7,250. This format, which they're showing here, is much too busy. You normally don't show the sales or the expenses here. Normally, you see just 4 things: the beginning equity, plus the income minus the withdrawals. I missed that. Oh, I'm sorry. Forgive me. This is not the sales. That's the net income. They did it correct. I thought they threw an extra line in there. Beginning balance was 5,000 for our intents and purposes. 5,000 at the beginning when he started the business. He made a profit, we just saw, of 5,250, but he withdrew 3. Your equity has now gone up to 7,250. Now we're ready for the balance sheet. The balance sheet reports a firm's assets, liabilities, and equity, confirms that the equation is in balance, and you can also call it the statement of financial position or financial condition. Notice that it does not say for the month of. If you do that, it's wrong. If you do that, it's wrong. Understand that the income statement is like a video. The income statement is a video. We had sales the first day, and then the sales went up. They went up. Our expenses went up and up. In other words, you're layering it on, and then at the end of the month, it's a total. These are not totals. These aren't totals. These are balances at the end of the month. This is what this guy had in the bank. He had $470 in the bank. These are a snapshot, the balance sheet. And I hit that kind of hard because it can mess you up if you're not real clear with that. I've been doing the New York Times Friday, Saturday, Sunday crossword puzzle for many, many years. And they had an error about 2 years ago where they used the word, the clue was something you find on a balance sheet. It was YTD, year to date, which is wrong. Long story short, I had a fun exchange of emails with Will Shortz, the guy I listen to on National Public Radio every week. He's the puzzle guy. He didn't want to believe me. 3 phases of the accounting process. Jesus, I don't know where we're going here, huh? Input, transactions, process, output. I have no idea what they're really talking about with this slide here. Input, yeah, transactions happen and you input them, meaning you do your journal entries or enter them into your system, and you recognize the effect on them, and you end up writing, coming up with financial statements. Let me see something here. I don't know if this is the last slide. If it's not, I don't think so. Counting process. Holy cow. Counting process. Give me a second here because I did want to see something else. Okay. Yeah, that looks like this is the last slide. I'm not in love with these Cengage slides. I really like the other book we used for a few years, Pearson Publishing, but the other faculty members had difficulties with it. They didn't like it. And I was the only one who voted to stick with Pearson because I like Pearson, plus my nephew, my brother's son, is an executive with Pearson, but we threw those guys out. But this was just a quick look at, it was just a quick look at some transactions, okay? I think we're at the end here. One thing I'm going to talk about just real briefly is the accounting equation must always be in balance, okay? I don't think any of you, if you ever do any bookkeeping or accounting in the future, will ever have that problem. No computer electronic system will allow you to post an entry that goes out of balance. Back when I was your age, when I was young, I used to hear people tell me that. But when I got out of college in 1970, everything was done by pencil. And it was so easy for the accounting equation to go out of balance. What a pain in the neck. It was hell in those days. So, be glad for the modern conveniences. So I guess that's what I wanted to go over today. Anybody have any questions, any comments on anything? We agree that money is good, right? That's what we're talking about here. We want to have some income. Okay. All right. Well, if that's it, I'll just urge you to go to your chapter 2 module, do the chapter summary, scoop up those points, do the quiz, which gives you, I guess, 3 opportunities, right? And what's the other thing? I guess that's it. The quiz. Oh, the exercises, the Cengage exercises. You'll have more homework this week with the exercises, okay? So with that, is it time to call it a meeting? What do you think, Natalie? Time to go?
Thank you.
Thank you.
Okay, Roby, time to take off.
Thanks a lot.
Okay, thanks, guys. And this will be up in, Cornelia will post this to Canvas, and I'll post it to my famous Bob Smagula YouTube channel. Okay?
Okay.
Have a good week. And you know when the
Thank
tutoring
you.
is, you got the tutoring now. You got me, you got Alan, you got all kinds of resources, okay? All right, you have a good day, everybody. Bye-bye.
Thank you.
Thanks,
Bye.
Bob.
Okay.